Welcome to Crete Carrier's Financial Education Series. Crete Carrier and Schaefer Trucking's podcast series that will help you manage and keep more of your hard-earned money that you haul in. Today, we listen in on a lunch and learn session held at Crete Carrier by Caitlin Moore, a retirement planning services educator with Union Bank and Trust based in Lincoln, Nebraska.
All right, well, I'm Caitlin. I am the financial educator for the Crete Retirement Plan. And today we're starting the first of 4 Road to Retirement series. It'll go on all year. We've cut retirement into 4 different areas. One, which we're starting today, is just the basics. We have to kind of understand language around retirement in order to understand where we're at. So our next one will be about 20s, 30s, 40s, and then pre-retirement, and then in retirement. So we're splitting this up as we go. So today we're just talking basics. So we're kind of learning bank language today, which is the foundation of all of it. Just a disclaimer, I'm not a financial advisor. I'm not here to tell you what to do. I'm here to just educate on options, and today just around that language and some basic concepts around retirement. So today we are going to talk about investment terms, which can be sometimes the most confusing part of any retirement plan. We'll talk through Roth versus traditional, asset allocations, and online resources. So we're just going to kind of go through a mixed bag of everything retirement related, and it doesn't matter where you are in the course of retirement planning, this all applies to everyone. All right, so let's talk about, we can't really see it real good up on this screen, but let's talk about just retirement as a whole. There's a lot of things that go into retirement planning, and I'm not going to go into this completely, but these are kind of all the facets. These are the phone calls I get. What is that about? So asset allocation and location. Where am I investing? What are my investment options? How do they work? How do they pay out? How much money am I making? Things like that. Market returns, huge part of that. How much am I earning or losing? And how does loss actually work within an account? Policy regarding taxes, that comes up a lot later on, closer to retirement, or if you're taking a distribution, especially an early distribution. Saving and spending, that's kind of what we talked about last time. In order to have a healthy retirement planning, having a budget that works in your everyday life is going to play into that. Employment earnings and duration, so vesting schedules, what is your employer giving you, profit sharing, matching dollars, whatever that looks like. And then longevity, how long are you in this retirement plan? Are you here for the life of your career? Are you taking it with you when you go to another company, things like that. And there's a lot of things within what I just mentioned that are in your control and which are out of your control. The biggest part that is out of your control is how the market does. We do not have control over that. We do somewhat as consumers. We are influencing the market, but we do not have control over the day-to-day earnings or losses that we see in our accounts. That's why sometimes you open up your account and it takes your breath away because you've either earned a lot or you haven't, or you've seen a lot of loss, which we've seen in the last couple of years. Things that are in your control, where you're putting your money. So what investments you're choosing, though we can't give you a right answer. What's the best? What's the worst? There's no right answer to that, but it is your choice where you're investing your dollars and how much you're putting in. That is within your realm of control. And then some of those things that are kind of not would be how much your employer is matching you. So are you maxing out the match? Are you here for the entire vesting schedule so you can leave with everything? And then how long you're at the company. So within a retirement plan, we say that investing in a retirement plan or investing in general is a very emotional experience because it's really based on what you can handle and what you want your end goal to be. So let's kind of shift to talk about investment terms, what you need to know. We kind of break this down, and our colors here at UBT do not work on the big screen. So I apologize for the bright green here, but I'll go through each of these. So one of the investment terms you need to know that you'll hear a lot from us as educators is risk tolerance. And that's exactly what I just mentioned on the last slide. What can you handle? The emotional part of investing or saving is according to your risk tolerance. How risky are you? So I have a friend that is just chases the adrenaline, just high risk, loves roller coasters. If it's at night, they've never been on that roller coaster, and it goes upside down 13 times, that's what they want to be on. I, on the other hand, am not a roller coaster fan. I'll go on them, but they better not go upside down, and it better be daylight because I want to see what's coming. So I am not a very risky person in general. I love a good time, going to an amusement park, but you're not going to find me on the riskiest rides. And that can absolutely apply to your investment life. How risky are you? Are you going to be all in the market instead of some bonds, and we'll talk about this, in money market? Are you willing to go all in with international funds, which can be very high risk? How long do you have? That often will have a measure with your risk. If you're going to be retiring in 5 years, you may not want to be that risky. I once had a participant that was about 25 go all in to one mutual fund internationally because he said, I'm high risk and I'm young. I have time to do this. So it all plays into your investment journey. But it can be very emotional because higher risk, though, is higher potential for return. You may not always see that. It may take a lot longer to see that. So risk has a big part of your retirement journey, and it's something that I can't answer for you. It is on an individual basis. How risky are you? Contributions and deferral. So this is the percentage or dollar amount that you are putting into your retirement account. Those are interchangeable words. So contribution, what are you contributing to your retirement account? Or deferral, what are you deferring from your paycheck to go into your retirement account? You could also have employer contributions, so matches or profit sharing dollars. These all apply to contributions. What is being put into your account or deferred from your paycheck? So sources, you may not see this a lot, or you may not hear it a lot, but you might see it a lot in written terms when you're looking over your retirement account. But sources are really just where are these dollars? You have sources or even buckets of money. So some various terms we have here are traditional versus Roth. So you have a traditional source, Roth source, and we're going to go into this a little bit more. A 403b, 401k, 457, a Roth IRA, and a traditional IRA. You have all these options, profit sharing, match dollars. These are all sources of dollars. They're accounted for as they are put into your account. So you have a matching source, and that's all accounted for. Or you have a rollover. Maybe you brought dollars into your account. That's a source of money. So we may ask you that question. Maybe you're looking for a distribution. Where do you want to get it from? What's the source? Well, I want to get it from my profit sharing bucket, or I want to get it from my Roth bucket. So it's just, where is the money coming from? When you look at your account as a whole, when you log into ubt.com, you're going to see a big number there, and that's accounting for all the sources, but we can individualize the sources for you of where these dollars came from. Investment elections, that's our next term here. Investment election is just your options. What are you electing to invest in? So I get a lot of calls, they're saying, hey, I want to look at my investment elections. Okay, are we talking about the ones you've already chosen, or are the ones that are your options? What are your options within the plan? So investment elections are what you are choosing to invest in. Volatility, that's our next word up here, and that is the degree to which an asset will fluctuate in value. So that is the degree in which our market goes up and down. In kind of layman's terms, it's the roller coaster ride that we go on when it comes to our stock market. Someday it'll be up, someday it'll be down, depending on where you're investing. Mutual funds, you will see ups and downs, but you won't maybe see these steep drops of ups and downs because we're looking at more averages over time. If you're looking at individual stock, we could go really high at a peak and then drop down the next day. I'm thinking of like Bitcoin. Those online currencies really do have high volatility. They're up one day, down another. So volatility, that is a word that we talk about a lot. In the last couple of years, we've had a very high volatile market. It has been not great. It has been up one day, down the other. Overall, it's been pretty bad. We're kind of coming up from that, so that our volatility is kind of evening out here. But it's kind of just explaining the roughness of the market. or the waves of the market. Goals. This may be something that you talk about when you're meeting with me as an educator. What are your goals? Long-term, short-term, retirement goals. Are you trying to make a certain amount of money before retirement? Are you just trying to save enough to, when you do retire, to replace your income? What are the goals that you have? Now, you may have goals outside of retirement planning, like children's education, paying off your car, paying off your house, budgeting. There are different goals that may influence your retirement planning as a whole. So I may ask you that. What is your goal for investing? I get the question a lot when it comes to investing in the retirement plan. What's the right move? Well, there's no right or wrong answer to this. And then I will follow up with, well, what's your goal? What's your end goal? When are you going to retire? What do you want to have in there? They say that you'll need about 80% of what you already spend in retirement. So we times that by 30 years, and there's your kind of magic number, your very generalized number. But if somebody says, hey, I want to travel the world, I need a lot of money, that's a goal. So there are different goals that influence your retirement planning, and it could just be everyday finances, not just the retirement account itself. And then our next word here is asset allocation. It says investment strategy that aims to balance risk and reward according to an individual's goal, risk tolerance, and investment horizon. So this is really looking at, do you want more stocks than bonds? Do you want cash or stable value fund? Where do your goals align with how risky you can be within the market and your investment options? So we're kind of looking at everything, your risk tolerance, your goals, maybe your retirement date, how much longer you have, your income, kind of putting that all together, and then you deciding, where do I want to put my money? Is it in a life cycle fund where I'm getting a little bit of everything, a very diverse allocation, or do I want to be more risky or more conservative, things like that? And again, we're going to go a little bit more into that piece of the puzzle. So those are some big investment terms or retirement account terms that we talk about all the time. We wanted to talk about them today so you can look back on the video if you need a refresh, because it is kind of the language of retirement accounts. And though we don't all speak bank, that's okay. That's why I wanted to kind of bring that to the forefront today. So now we're going to go into traditional versus Roth. So I have been in a lot of discussions lately with folks. I'm 37, and I've been in a lot of discussion with folks in their upper 40s, even though that's not a huge age gap. The language around traditional versus Roth is very different generationally. And we can argue that point all the time, but I want to kind of set this stage for what traditional versus Roth is in the language and then how they work. Because here at Crete, you do have traditional pre-tax, those are interchangeable, and Roth options, but they're still within your same 401k account. And I think that causes some confusion sometime because, and I'll go into that as we see it on the slide, but it's confusing because language over time has not evolved into what it is, because our investment accounts have evolved, but the language behind them has not. So I just wanted to talk through that. So we have an individual retirement account, an IRA, or an IRA, as some folks call it, but we're going to call it an IRA. And then we have an employer plan, which is what you have at Crete. You have an employer plan. Now, planning for retirement, you can have both of these. An IRA, you'd open up at the bank. You can open that up here at UBT. It's within our same department. It is just outside of your employer. That's why we have those two bubbles up there to talk about that. So you have two types of retirement plans. Now, each of them have traditional or pre-tax options. So consider those buckets of money. So if we look at the employer plan up here, which is what you have here at Crete, you have a 401k. And within, that's what we call it, your 401k retirement plan, but you also have pre-tax and Roth. So if you consider yourself holding an umbrella over you, that's called a 401k, and the rain is falling down into buckets of money under you, you can have Roth or pre-tax. It is all within your umbrella of a retirement plan. It's just coming out of your check differently, and when you're earning dollars in investments off of either of those buckets, it is taxed differently. We're keeping track of that, okay? So you can have a Roth 401k. You can have a pre-tax 401k. You could also, on the flip side, have a Roth IRA or a pre-tax IRA. Those are two different ones. You can go to the bank and say, I want to open up a Roth IRA. And they're going to say, okay, how much money do you want to put in there? And that's going to be your post-tax dollars, and we'll get into that in the next slide. But you can have those. So I get a lot of calls and folks say, hey, I want to talk about my Roth IRA. Well, that's not my department. I can put you over to the IRA folks. Well, no, I have an IRA within Crete. Oh, you're talking about your 401k. Okay, so there's this interchangeable language right now. It's not even interchangeable. It's just kind of how people have talked over time. But your employer plan here is not an IRA. It is an employer plan. It's a 401k. An IRA is something you would set up at the bank by yourself, outside of company dollars. Crete has nothing to do with that money. So when we talk Crete plan, we're talking employer side. You have pre-tax or Roth. There are other types of company accounts, 403B, 457s. 457s are very individualized. Usually within a 457, the company is not contributing anything. Profit sharing match, but it's through your paycheck. You can defer more dollars into a 457. A 457 is kind of like an extra account after you, within some plans, you can't add more than you want to into their 401k. So you open up a 457 and you can add more out of your check. But for the most part, you're going to see 401k. 403b indicates it's a government entity or a nonprofit. So there's some tax stuff on that side too. But within those accounts, you have a pre-tax and Roth option. So for the Crete plan, we have an employer plan. We have a 401k. You have a 401k here. And you have pre-tax and Roth options to contribute into that 401k. And that's where we're going to go into what does that mean. So traditional or pre-tax, those are very interchangeable language. I tend to say pre-tax. That's just, I think it's a little bit easier to understand pre-tax, but a lot of people say traditional, and that's okay. But for what I'm talking about, I'm just going to stick with pre-tax. But we are talking traditional. And then you have Roth. So within the Crete plan here, you can defer money out of your check, either pre-tax or Roth. So pre-tax side, money's coming out of your check, put into your 401k before taxes are taken out. So we're looking kind of at gross pay. It's actually reducing your taxable income for the year. I like to use the example, if you make $50,000, you put $10,000 into your account, then come tax season, you're going to pay taxes on $40,000 because you have deferred these dollars pre-tax, put them into your 401k, and when you go to retire, you will then pay taxes on those dollars. People use the pre-tax option to lower taxable income. Some people are at the cusp of a new tax bracket, and so deferring dollars into their 401k brings that down. This works great, especially when you have a dual income in the house. So it's a great way to bring down that taxable income, but you will pay taxes on it in retirement, okay? The Roth is just the opposite. You are going to defer dollars into your account, but you're going to pay taxes on those dollars now. And we'll talk about the perk of doing that. But if you make $50,000, you put 10 into your 401k, then you're going to pay taxes on $50,000. Okay? You can have both buckets of money in your account. Some people, let's say they put 6% into their account, they'll do 3 and 3. They're only paying taxes on that 3% Roth. The other 3 is reducing their taxable income for the year. As a whole, pre-tax or Roth, doesn't matter which side of the bucket. This year in 2023, the IRS limits how much you can contribute to $22,500, and it could be both sides. That's the total amount going into your account, pre-tax or Roth, or both. If you are over the age of 50, you could put in an extra $7,500 for a total of $30,000 for the year. Doesn't matter which side of the coin you're going to do that on. Now, it is up to UBT to send you your tax information to say, hey, you did Roth, you're going to owe this much in taxes. It's still taxable income. It's going to show up on your W-2 that you get from Crete. It's all taxable income on the Roth side. Pre-tax, it is not. It will be in retirement. Now, here comes the perk part. The perk comes with the Roth. The IRS is kind of making a negotiation with you to say, hey, if you'll pay your taxes now, at whatever tax bracket you're at, you're just going to pay those taxes on the deferred dollars that you put in your 401k. You don't have to pay taxes in retirement. Okay, great. I have some free money essentially that I can just take out without hitting a tax bracket, anything like that. But also on the Roth side, let's use that $10,000 that you've deferred in here. It's going to be invested, hopefully making a ton of money for you. That's our goal. We want to put $10,000 in here, and over the life of our career, by the time we retire, maybe we have tens of thousands of dollars in return from investments. That all is tax-free in retirement on the Roth side. So when you invest any money and you get a return, that's taxable income. Across the board, doesn't have to be in a retirement plan, it could be anywhere. You're supposed to claim those dollars as taxable income. But when you are putting money in Roth, on the Roth side, you're paying taxes now, the IRS is just saying, hey, don't worry about your earnings becoming taxable income. That's the perk. So the younger you are, the more time your dollars are in your Roth account, the more it's growing, hopefully, with investments, and all of that is tax-free. This could be hundreds of thousands of dollars over time, especially if you're starting real young on the Roth side. Your Roth account has to be open for 5 years for those earnings to be tax-free. So if you are doing Roth later on in life, that's okay. Just keep in mind when you start taking money out in retirement, it needs to have sat there for about 5 years in order for all the earnings to be tax-free, which is usually not an issue for most folks. They just take out of their pre-tax side, not a problem. But the second $1 goes into the Roth side of the account, that's your benchmark for 5 years. That's where it happens. So the perk of retirement planning with a Roth is that the earlier you do it, the more compound interest, meaning I'm investing my money, I'm earning something, we're going to throw it back in the bucket. And then it's going to earn a little bit more, we're going to throw it back in the bucket. Over time, that's how we earn all this extra money in our retirement accounts. And on the Roth side, it's all tax-free, which is going to save you a ton of money in retirement. Now let's talk about the idea of contributing to your Roth bucket here at Crete. But what about profit sharing or match dollars, which you are eligible to receive? Now Crete is never going to put money in your account that they're paying taxes on. It's a deferral for them. It helps them. So they're always going to put into your pre-tax bucket. But that doesn't mean they're not matching your Roth dollars. So if, let's say, after you contribute, you put $25 in here next payday on the Roth side. You pay your taxes on it, but $25 is in your account. They're going to match off that $25. But they're just going to throw it in the pre-tax bucket. So most of the time within an employer plan, if there's a match or profit sharing from the company, and let's say you only contributed on the Roth bucket, you will have a Roth and pre-tax bucket, because that's where the company is going to put their money. So you will have both taxable and already taxed dollars in the account when you go to retire. It's really nice because then in retirement, an advisor would likely tell you, hey, we're only going to take out of the pre-tax side up to, say, the lowest tax bracket you could possibly in, which right now is 12. So let's take enough money to cap that. We'll pay our 12%. But then if you need more money in retirement, take it out of your Roth, because you don't have to pay taxes on that anymore. So there's this perk of having both sides of the coin in retirement, which you will if you contribute anything to Roth. So it is okay to do Roth, to contribute Roth, to defer that way. And Crete you will still receive the benefit of what Crete offers within the match and the profit sharing dollars. You will just have to pay taxes on that contribution later in retirement. We're keeping track of all of that. So on your specific quarterly statements, you will see it broken down for you. It will say 401k, traditional pre-tax, whatever amount is in there. It will say profit sharing, whatever Crete's put in there for profit sharing. It'll show your Roth amount, whatever is in there. You have it very much broken down, but your overall account balance is just the total amount of money that's in your account working for you with investments. So I hope that helps to understand. I get a lot of questions about this. So if you're looking for a particular reason of, hey, should I do pre-tax, should I do Roth? Give me a call. I'm happy to talk it over for you. But again, you can contribute to both sides too, and you're not going to lose the Crete benefit of a match or profit sharing. They are still going to contribute. Let's talk about the investments now. Whew, it's a lot here. Okay, so let's talk about investment allocations, diversification. What does it look like here at Crete? So like I said earlier, the higher the risk when you are investing, the higher the potential for a return. It might take a little while to see returns, meaning earnings. But if you're pretty risky, let's say you're putting a lot more into the stock market, international stock market, that's considered high risk, and you could see a lot of money and a lot of growth over time when you're investing that way. So it really just depends on what you want to do. We do have stock options here. They're mutual funds. We have bonds. That's outside of the market. You're basically loaning out your contribution. You're going to get that back with a little bit of return. It's a very conservative way because you're not banking on the market doing well. You're just going to get that money back over time. And then you have a money market account, which is basically cash. It's putting that in a reserve, kind of like a savings account. You're not going to earn much on a good year, maybe 2%. It's meant to keep up with inflation and make sure the dollar earned today is the same dollar in 30, 40 years. That's all it's meant to do. It's not supposed to earn, it's just supposed to keep your balance the way it is. So it's a very, very conservative way of investing. If you are looking to make money, a money market is not going to make you any money. Bonds, on the other hand, make anywhere from 3 to 6% on a good year. Which is pretty average. When we're looking at average investment returns, we're looking at 8%. So they kind of come in on a good year right under that. But your stock market could be negative numbers to however high it could possibly get. So your potential there is huge. And let's talk about what that looks like within the plan here at Crete. So you do have two options that you could choose from. One is a hands-on version, one is a hands-off version. So if you're not good or not interested in investments, we do have to put your money somewhere. But we do have this option, which is the target date funds for people who want to be hands-off. You don't have to know a whole lot. You don't have to know anything, honestly. You just have to have a birth date, and then we're going to drop you right into your investment fund according to your birth date. So what this chart is pie charts that are according to your age. So each pie chart represents a mutual fund of a couple thousand companies. The red is U.S. stock, yellow is international, the blue and medium blue is bonds, and the light blue down at the bottom is money market. The date above each pie chart indicates the date closest to when you would turn 65. We're looking at that as your average retirement date. Okay, so it's the year closest to when you would turn 65. Like I said, I'm 37. I'm a 2050er. That says that I'm probably going to work until in and around 2050. Kind of makes me sad. That seems like a long way away. But that is my number, my magic number within these target date funds. So what that means, and that's our top left here, if I am investing in my target date fund, I'm getting a whole portfolio. The portfolio means all of my investments. It is diverse, so it's got a little bit of everything within that. But the great thing about Vanguard target date funds is I don't have to do any of the work. It's all being done for me. So if I'm a 2050er, I am going to put my money in my Crete account, and every pay period, Vanguard's going to take that money and invest it according to my pie chart. So they're going to put 54% into U.S. stock, 36% into international. So 90% of my dollars are going straight into the stock market, every pay period. And then that 10% they're keeping in bonds. I don't have any cash. I don't have any money market in my account yet. Because according to Vanguard, I'm way too young. And honestly, until you're about 10 years from retirement, Vanguard still considers you young. So I am part of the youngest group up there, being 37 and still having an average of 30 more years to work. So they're putting 90% of my dollars into the stock market. They're investing for me. They're deciding who we're going to invest in. They're buying, selling on my behalf. They're going to try to make me the most money they could possibly make. Every year, though, they're going to start decreasing the amount of money they put in the stock market for me. Because as I come up on retirement, I need to have a little bit more conservative bonds, money market. I can't be that risky at retirement time. So every 5 years, I'm going to jump table. I will always be a 2050er. And eventually, where that 2045 is, we'll say 2050. And I'm going to follow that all the way to retirement. So as you can see in 2045, the 2045ers are putting a little bit less money into the stock market than us 2050ers. And every 5 years, you're going to see it jump tables. The 2020 fund there at the bottom is where current retirees are sitting. If they're in and around 65, this is how their portfolio looks, which is only about 45% in the stock market. The rest are in bonds and money market, because by the time you get to retirement, you want to know where your money is. We can't be risky at that point. But there is a fair amount in the stock market to hopefully earn back what you're taking out. Because in retirement, we're finally taking money out of our account, but we're trying to earn that back too. So Vanguard's job is to kind of earn that back, to kind of keep your balance where it is, which is great. The income fund here at the end is for ages 73 and above, just to take you through the rest of your retirement. Very, very conservative, where only 30% of the account is in the stock market. Again, just kind of preserving a balance, trying to earn back what we're taking out to make the supply last, essentially. I can choose my account, the 2050. I can say, hey, you know what? I am not that risky of a person. Even at 37 years old, I'm not that risky. I want to start at the 2035 fund. And I could just choose that as my account, and then Vanguard's going to take it from there. I will end up where the 2020 years are early, but that's just going to keep me conservative until retirement. But if you choose nothing, we're going to default you here. That's another thing. We think that Vanguard does a really great job with these target date funds. It's according to your birth date, not where we want to put you. So we're just going to take your birth date and put you in the appropriate fund, but you can change this at any time. But the great thing about this is Vanguard's doing it all for you. And I like that idea, even though I even work in retirement. I like the idea that Vanguard's doing it all for me. They've got a lot on the line, and we think they do a really good job, and it's keeping you risky when you're young, keeping you conservative as you approach retirement. Now, if you like the idea of investing and want to do some homework, or maybe you have an investment advisor, you do have a hands-on version of what we just saw. So you have a money market account there at the top, so that's that cash fund you can choose from. Kind of keep your money, your balance where it's at. You have 2 bonds to choose from, so you can put some money in some bonds. Again, on a good year, 3 to 6% return. So very conservative way of looking at things. And then you have stock funds, large, medium, small. Those boxes are the size companies within the US. So your large there, let's see if you have it. Nope. But your large would be your bigger companies within the US, your Disney, Walmart, Target, those bigger companies. And then smalls could be, startup companies, small companies looking to grow, whatever that looks like. And then you do have you have an international option also. So you can get invested in international companies that maybe we have some influence over because we buy their products, but they're not ours here in the US. You could choose one of these, you could choose 3 of them, you could choose all of them. Whatever you want to do, you can do it within the scope of what Crete offers. So we can't go outside of what we offer. You have the Vanguard target date funds, or you have these. So within your 401k, this is your option. No, we cannot buy into something else that is not on the list. If you wanted to go that route, you'd have to take outside funds out of your own bank account in order to invest that way. We do have a really great investment option within UBT, very hands-off if you wanted to do some extra investing outside of your 401k. That has a lot more options, but it is the bank is kind of running the show as far as what those options are also. But you can also get into IRAs. Those might have a number of options. So instead of picking a mutual fund, which is a couple thousand companies, couple hundred companies, you could be choosing Apple or Disney, individual stock that you want to do. But you can't do that in a 401k. In this particular 401k, we are just offering these options that both Crete and UBT have come together and decided is best for the company. So those are your options. You can change this at any time. So just because you have chosen investment options does not mean you can't log in to your account and change those at any time, which is a great feature that we have. I wouldn't suggest day trading your account, meaning today I'm buying, tomorrow I'm selling. That's not what it's meant to be. That's not how mutual funds are meant to go. Mutual funds are, each box would be a mutual fund of a couple hundred companies. We're looking at averages over time, so they're not meant to be day traded. You certainly can buy and sell within the scope of what you have within the Crete 401k. You could do that every day, but you might get a phone call. I'll be honest with you, because it's not meant to do that, but you can do that if you would like to. So I just want to kind of bunny trail here real quick. When you call me as an educator or talk to someone in our call center and you say, where should I be with investments? I can't answer that for you. I don't have an answer. I'm not an advisor, first of all, but also there's no right or wrong answer to investing. It's where do you want to be? Do you want to be risky? Do you want to be conservative? Do you want to be hands-off, hands-on? It really just depends on you. I can certainly educate you on these, but I can't tell you what to do. I'll help you move things around on your account. I can do that, but I can't tell you what to do. And just honestly, there's no right or wrong answer to investing. If I knew how to make everyone rich, I promise you I'd share the secret, but I don't have that secret because there's no such thing. So we're just doing our best. And if you want to call and have me kind of walk you through some things, I'm happy to do that. That's what I do. That's what I'm here for. Online resources. This is what our website currently looks like when you're logging in. UBT is a bank in itself. If you bank with us, awesome. Thank you so much for banking with us. But you cannot reach your retirement account through your banking login. So you're going to have to go to ubt.com/RPS, Retirement Plan Services. And this is what it would look like to log in. You'll have your individual username and password. If you forget what that is, get locked out, just give us a call. We'll reset you. Not a problem. But this is something that you would have to enroll to do so. Now, you would be enrolled in the 401k here at Crete, but enroll in the online piece of the puzzle. You have to go on and do that. We have instructions here at Crete. I have them. I can send them to you. You'll establish your username and password, and if you have any issues with that, just give us a call and we'll reset you. You can go back to that original username that you thought it was. So it's not a problem. But this is where you're going to see everything that I've talked about: your account balance, your Roth, pre-tax buckets of money, how much you're contributing, what investments you're contributing to, how much profit sharing did Crete give you, how much match did they give you, how much came out of your paycheck and went into the account. All of that is there within the website. So I would encourage you to log on and get that username and password all set up for you. But we can certainly walk you through it. Crete has a direct line to UBT, our call center, and there's one call center employee that is designated to Crete. So you get individualized care there at UBT. But I will tell you that anytime you call us, you are calling us here in Lincoln, Nebraska. You're not calling outside of that. We're at 27th and Pine Lake. So if you talk to someone at UBT, it is there at that location, anything retirement related. So give us a call if you need us. And call if you have questions. Here's my information here, my email. I am the designated Crete educator, so I'm the one that they're going to throw the questions at. If I'm unavailable at the time, or would be if I'm out on education for other companies that I work with, then somebody else can take the call, but I'm the designated Crete educator, so I'm the one usually that you're going to get a hold of. We do work regular business hours, 8 to 5, but we will certainly get back to you when we can. We do have an app. Once you have logged in online, established that username and password, we do have a great app, UBT Retirement. It is different than our banking app, which is UBT Go. Again, we can't connect the two for security reasons, but if you get onto UBT Retirement, you could use that same username and password and get it all on your phone, which makes it even easier, which is great. It's not easy to make trades on the app. We would strongly encourage you to use a computer for that, but you can use your phone, like the regular internet on your phone, to do that, and we can walk you through that. So. All right, well, that's all I've got for you today. Again, if there's more questions, feel free to reach out. But our next session of this, we'll be talking about 20s, 30s, and 40s, retirement planning during those years, kind of goals that you might be looking for, asset allocation, so how risky would maybe Vanguard suggest you be, things like that. So we're going to kind of get into more nitty-gritty of retirement planning according to age bracket. So join us for the next one, but thank you for joining me today.